Hi, everybody. Well, this is part one of a four-part series on how to do a discounted cash flow analysis and really how to value a company. And today's going to be kind of fun because we're going to be looking at Patrick Mahomes' contract ultimately to as our base case. But a couple quick concepts just to make sure we're all on the same page here. Okay, so the let's just say, for example, that you have $10 today, and let's say that you were able to invest that $10 at say 8%. Okay, and let's say actually you can invest it for 2 straight years at 8%. Okay, so let me just move that there. So what would that grow to? So let's say I can grow $10 at 8%. So I'd multiply it times 1 plus, and then we'll just reference that cell right there. That's 8%. So after a year, it'll be worth $10.80. And after 2 years, it would be worth $11.66. Let me just get that decimal down to, two decimals. Okay. So the future value of $10 invested at 8% over 2 years, the future value is $11.66. Conversely, the present value of $11.66 to be received 2 years from now, discounted at 8%. The present value of that is equal to $11.66. We'll reference that cell divided by 1 plus the interest rate, which is 8%. I'll just grab one of these. I don't need to grab both because they're the same number. And I'm going to hit it to the caret 2, to the second power. Okay, so it's 1.08 squared. And so that number is also $10. Okay, so the present value of $11.66 received 2 years from now, discounted at 8%, is $10. These are basic concepts in finance that are used to value a company. So let's see, how does this apply to this guy right here? We know who this guy is. This is Patrick Mahomes. Okay, great football player, plays for the Kansas City Chiefs. I'm not really a Chiefs fan, but I got to give him credit. They're a pretty good football team over the years. He's smiling for a number of reasons. Well, first of all, he makes a lot of money, and we're going to take a look at that money that he makes in a second. He's also a handsome guy. He plays for a great team. He's got a lot of good things going for him. So let's take a look at his contract. This is the beautiful thing about Patrick Mahomes' contract. It is all publicly available information. You can find it on the internet, as I did here, and it is laid out nice and clean for us. He gets a base salary, he gets a roster bonus, he gets a workout bonus. Can you imagine getting paid $550,000 in the year 2023 just to work out? I think I have to pay gym fees that are higher than that. It seems like sometimes, but the cash flows kind of are weird in some ways. The 29 million, they go to 40, they go all the way to 59 million one year, then they go back down. It's kind of weird how it's all laid out. Let's check it out though. What's the value of that? What would you pay today if you could receive this stream of cash flows that goes through the year 2031? What would you pay for that? Well, let's just first of all sum it up. Let's just see what does all that add up to. So if I hit sum and I click on this here, and then I hit shift and then the right arrow that just highlights all of this stuff here. Okay, then I close off that equation right there with the right bracket. And so it sums to $477 million. So, a lot of people, you've probably heard in the press that Patrick Mahomes, he signed a contract worth something like $480 million. Well, that's not exactly true. That's summing up all those future values to get to that number. But the reality is you wouldn't pay $477 million today to earn this stream of cash flows. You wouldn't do that because you know that if you had that $477 million and you invested it at 5%, it could generate more money than this, right? It could generate more money than that. So what we need to do is we need to discount these values back to the present value, and we need to use some kind of a discount rate. We're going to use this 5% just hypothetically. Last example, we used 8%. Let's say Patrick Mahomes has a lot of good investment opportunities that he can find at 5%. He can invest his money at 5% pretty comfortably, and he makes these cash flows pretty comfortably. The reality is also these cash flows aren't really guaranteed. I think at some point, maybe it's in 2026 or so, from that point forward, it's not really guaranteed money. He's still got to make that team. And, he thinks he's going to because he's a good player and he probably will. But you never know what can happen in the future, right? So let's just take it as given that these are the values. He's going to get them, and let's discount it all back. Okay, so what's the present value of that? So what we can do is we can create what's called a discount factor here. Discount factor. And a discount factor is what we're going to multiply these future values by to get a present value. And that's just going to equal 1 divided by 1, let's put this in parentheses, 1 plus the interest rate. And so that's 5%. Now the thing is, that very first year, so if I hit that, it says 0.95. But the problem is, this first payment, let's assume it's the year 2020. We signed this contract and we immediately give him this money. And that's kind of what happened. He got an immediate signing bonus of $10 million and got his money for $825. So this all happens right away. So really, we want this first discount factor to be 1. So what we're going to do is we're going to raise this to the 0 power. Now you're sitting there thinking, why would you do that? Why wouldn't you just type in the number 1? And that kind of makes sense to do that, but let me just show you why I don't. What I'm going to do is ultimately I'm going to drag this across, and next period it's going to see it references C1, which is to the 0 power. Next period it's going to reference D1, which is to the first power, then to the second power, then to the third power. So that's what I want to do. This is a little trick I learned in Excel. You put all this across here, and you can just drag. Now the thing is, I don't want to change C8. I want C8 to always be the same. That's my cost of capital. So what I want to do there is hit F4. Okay. When you hit F4, when you highlight something and you hit F4, it puts a dollar sign in front of the C and a dollar sign in front of the 8, and that's going to anchor that number. So you'll see what I mean by that in a second. Let's just drag these across here. So, and you will see these numbers get progressively smaller, but you can see like in year 2 here, it's always referencing C8. See, year 3, it's always referencing C8, but it's referencing a different number up here because I didn't anchor it. It's referencing F1 here. It's referencing G1 here. So this is to the 4th power. This is 1 divided by 1.05 to the 4th power. All right, so that's the beauty of it. Now what I can do is I can calculate the present value of the cash flows. Okay, these are the horizon cash flows. Let's actually change it to present value of horizon cash flow. Okay, this is the 11-year horizon, 10-year horizon. So let's do this. So we multiply the actual cash here, which is just these numbers in the cash. This is just the sum of these 3 numbers. That number being 0, of course. So I'm going to multiply that number times the discount factor. Obviously, the first one is just multiplied by 1. It's still going to be 10,825,000. But as I drag that across now, you can see that these numbers start to depart, and the departure gets bigger and bigger because these numbers get progressively smaller. So for example, this is the big year. In 2027, he gets 59,950,000. So, but the present value of 59,950, today's present value of that cash flow in the year 2027 is only, quote unquote, only 42.6 million. So 59,950,000 to be received, call it 7 years from today, discounted at 5% is 42,605,000. Okay. So he's still happy, but he's probably not going to be as happy now when he adds up all this stuff. It's not going to quite equal this number here. But let's see what it does equal. Let's do the sum of horizon cash flow. Sum of the horizon cash flow. These are finance terms. We talk about the horizon cash flow when we're doing DCF analysis. So let's just go sum of all of this stuff. Man, wouldn't it be great to be a quarterback in the NFL making this kind of money? I picked the wrong career. Okay, so we got $352 million. That's the present value. This is like some of these future values, but this is really what his contract is worth. So, Patrick Mahomes might be happy to receive $350 million today And he says, well, if you give me that money today, I can just invest it at 5% and I can just basically generate these cash flows going forward. I can earn that money going forward. Now, the problem is that the head coach of Kansas City, Andy Reid, he doesn't want to pay Patrick Mahomes $352 million today, because then Patrick Mahomes takes that money, he says, thank you very much. And in 2 years, he says, you know what, I want to, do something else. I want to be like an artist for a living, and I don't want to play football anymore. And, oh, you've already paid me this money, so see you later. So that's not good for Andy Reid. So Andy Reid says, well, I'll tell you what, Patrick, we're going to give you $350 million. Okay, we're good for that money. But I need you to commit to playing for me until the year 2031, because you're so good. And Patrick says, okay, well, I do like football, so, okay, I agree to that. I'll agree to that. So, the agent is excited because the agent probably gets like 5% of this money. So the agent's like pretty psyched right now. But that's kind of how it starts. It's probably like, I need something that's worth 350. Okay, and the coach says, I need you here for 11 years, and the agent says, I need 5%. And so that's how you value the present value of these cash flows. So let's flip it over to a company now. Let's say that you want to buy a firm. You want to buy a business. Let's say you want to buy a pizza business. And this pizza business, because you like pizza and you just want to just own a pizza business, you think it's pretty cool. Well, the pizza business is a good business, and it's going to give you $50,000 in cash flow that first year. And you think the second year, 55, and then 65, and 73, and then 75. And then, at that point, after the year 2025, you think, at this point, I think it's going to grow at like 3%. So it's going to grow at D15, which is this. Oh, let's make that 3%. It's going to grow at 3%, forever at that point. And so, you see it's referencing D15. You think the pizza business will just go 3% forever. Now, I could keep multiplying it by 3%, and I could do 2026, 2027, and I could just keep going for years and decades to the right and just keep mapping this out. But that's not generally the way it's done in the finance industry. Generally, what we do is we forecast out fat cash flows for 5, maybe 10 years in some cases, and then we come up with a terminal value. The terminal value starts with this growth rate, and then we create this terminal value using a model called the Gordon growth model. So I want to show you how that works right now, okay? The Gordon growth model basically says the value of an enterprise that's growing constantly forever is equal to next year's cash flow divided by the cost of capital minus the terminal growth rate. So it's free cash flow 1, which is a year from now, divided by R minus G. Okay, let me just map this out for you, and I'll show you what I mean. Let's go through all of this, though. Sorry, I kind of jumped the gun a little bit. Let's first do our discount factors here. So let's go through all this exercise again. It's 1 divided by 1 plus R, cost of capital. And I've got my assumptions on the outside of my model. Okay, I could have typed in 5% there. I'm not going to do that because, and I'll show you in a little bit why, but it's going to allow me to be flexible in my modeling and analyze it a little bit better. So I'll show you what I mean by that in a little bit. But let's raise this now to the first power, because we're going to assume this first $50,000, it's not going to come for a year from now. Today's 2020, early 2020. This is going to come in 2021, a year from now. And so I'm going to have to discount this $50,000. All right. And so then I've anchored the cost of capital. I've anchored this 5% down here. Now I'm going to drag this across, and I'm going to stop right here. I'm not going to do any more discount factors. I'm not going to do one over here, and I'll show you why in a second. Let's calculate the free cash flow, the present value. Let's go equals this 50,000 times that discount factor, which is this number here. And let's drag that across. Okay? And now what I could just do is, just like we did with Patrick Mahomes, I'm just going to sum this up. I'm going to sum up the present value of the free cash flow. That's my horizon. Okay, and I got $272,477. Now what I need to do is come up with a terminal value, because what's going to happen is after 5 years, I'm going to be like, you know what? I'm tired of the pizza business. I love pizza, but I don't want to run this business anymore. In fact, I just want to sell it. And so I got to figure out what I'm going to be able to sell it for. So this is where I use that Gordon growth model. I'm at the end of 2025. It's going to grow at 3% forever, or this terminal growth rate forever. So the value at the end of 2025 for my firm is going to equal the next year's free cash flow divided by R minus G. R is my cost of capital. G is my terminal growth rate. Okay. So at the end of 2025, my firm is going to be worth $3.862 million. I'm going to be able to sell it for that. And that's how it's done in the investment banking world. They will come up with a terminal period and then come up with a terminal valuation. But here's the thing. That's what it's worth at the end of the year 2025. What I want to know is what's the present value of this amount today. That's what I can sell this in 5 years from now for $3.86 million. So what's that worth to me today? Well, I got to figure out the present value of that. So I'm just going to take that number and I'm going to multiply it by the discount factor that exists at that time. So it's the end of 2025. That's when this enterprise is worth 3,862 at the end of 2025. So I'm going to multiply it by that discount factor. And that gives me the present value of 3.026 million. So now I'm going to sum those two up. And that gives me the value of the company based on my assumptions, based on this cash flow forecast, based on that terminal growth rate of 3%, based on this cost of capital. This is what the value of my firm would be. I should be willing to pay $3.298 million. If I'm an outside investor and I want to say, what do I want to pay for this business? And I think I can earn this cost of capital and this terminal growth rate, these cash flows, I will pay $3.298 million for this business today. That's what it's worth. Now, here's the thing. In the business world, this is what's called the unlevered free cash flow of the firm. What that means is the free cash flow that a firm generates is the cash flow that it generates before it pays off the bondholders, the bank, the equity holders. In other words, before it pays off any of the financiers of the firm. How let's say that this business is financed with part debt and part equity. Well, I have to figure out how much is owed to the bondholders and what's left over is owed to the equity holders. So, if I wanted to figure out what the equity value is in this firm, I'd have to take this enterprise value and strip out what's owed to the bondholders. We'll do that later in another video. I just want to tease that up for you now. In one of the later videos, I will show you that. And then what I would then is take that equity value that's left over, divide it by the number of shares outstanding if it's a publicly traded company, and that would give me a stock price, an intrinsic value of a stock price. Again, all later. The other thing that we're going to show you later is how I get these free cash flow numbers. Here I'm just giving them to you. I'm kind of starting at the end, and we're going to work our way back and figure out how to get these free cash flow numbers. We're also going to figure out how to come up with this cost of capital, and we're going to figure out how to parse this enterprise value up between the bondholders and the stockholders. So we're going to figure out some of the details behind this later, but right now I'm kind of giving you these assumptions. Now what we could do, and I want to show you how building these assumptions on the outside of the model is pretty powerful. Let's say I want to change my cost of capital. Let's say, because cost of capital is an estimate. I don't know what my real cost of capital is. Let's say it's actually 6%. So it's actually higher cost of capital. Well, if it's 6%, watch what happens to my enterprise value here. It's going to go down, right? And it goes down a lot. Whew. That's a big difference. And what if my terminal growth rate really isn't 3%? Maybe it's only going to grow 2% from that point forward. Well, then it's going to go down even more. Now it's down to 1.693 million. You're getting a big range just by tweaking these numbers just a little bit here. And so this gives you a little insight as to what investment bankers do, or people that do capital budgeting do, is they won't just come up with one number. They'll come up with a number and with their best guess as to what the cost of capital is and what their best guess as to what the terminal growth rate is. But then at that point forward, they'll tweak these numbers a little bit, and they'll do a sensitivity analysis, and they'll come up with kind of a distribution, like a bell curve, a distribution of valuations based on different assumptions. And just to do some kind of sensitivity analysis. So that gives you a little sneak preview of what discounted cash flow analysis is all about, how to value a firm. We're going to get into this a lot more in the next few videos. This is only part 1 of part 4. So if you like this video, what I would like you to do, or love you to do, is give it a thumbs up, or even subscribe to this channel. I put out videos regularly on this channel. This channel is all about making finance fun for students. So thank you for watching, and hope you enjoyed it, and we'll catch up later.